Between 2025 and early 2026, foreign institutional investors pulled over 2.62 lakh crore rupees out of Indian markets. That exit triggered immediate damage. Key indices like the Sensex and Nifty dropped by double digits as billions in liquidity vanished from the secondary markets. The most visible symptom of this vacuum is the currency. In May 2026, the Indian rupee crashed past 96 against the US dollar, a record low that has psychological and economic consequences for the entire nation. This sudden exodus raises a difficult question: why is the global smart money fleeing all at once, and is the underlying Indian economic story finally starting to crack? This exodus is a reaction to external geopolitical shocks. Conflict in the Middle East recently pushed Brent crude oil past $100 a barrel, sparking fears of a sustained energy crisis. Because India imports over 85% of its oil, these prices immediately widen the trade deficit and put immense pressure on the national current account. At the same time, global money is being pulled toward the safety of the West. U.S. Treasury yields have held firm near 4.5%, offering high returns with zero risk. The math for global funds is simple. A guaranteed 4.5% yield in US dollars is often more attractive than a volatile 10% return in India, especially when a falling rupee erodes those gains the moment they are converted back to dollars. There is also a major rotation toward North Asia. Global capital is leaving Indian equities to chase the semiconductor and AI hardware boom in markets like Taiwan and South Korea. This creates a destructive feedback loop. Foreign investors sell Indian stocks and buy US dollars to move home. That mass demand drives the rupee lower, reducing the dollar value of remaining investments, triggering a fresh wave of panic selling. The 96 rupee exchange rate is the mechanical result of this self-feeding global cycle. At the micro level, this exchange rate forces a massive redistribution of corporate profits across different sectors of the economy. Import-dependent industries are struggling. Commercial airlines, for instance, must pay for fuel, aircraft leases, and maintenance in US dollars, even as their primary revenue is earned in a weaker rupee. The IT sector is a surprising laggard in this economic cycle. While currency devaluation usually boosts their margins, they are currently facing slowing US corporate spending and fears that AI could disrupt traditional outsourcing models. But where importers lose, exporters gain. Industries that manufacture locally but sell globally are seeing their international revenues multiply when converted back into rupees. This shift is currently benefiting pharmaceutical companies and specialty chemical exporters, who are capturing wider profit margins thanks to the currency movement. Currency crashes reorder the economic ladder, moving competitive advantage away from importers and toward exporters. The Indian stock market has avoided a total collapse because domestic institutions now have the scale to absorb the supply foreign funds are dumping. Local investors, powered by monthly SIPs and mutual funds, have pumped over 3 lakh crore rupees into the market, offsetting the 2.62 lakh crore that left. This has pushed domestic ownership of Indian equities above foreign holdings for the first time in history. While the currency and capital flows are volatile, the underlying economic metrics remain steady. Corporate earnings are showing signs of bottoming out, the government is fast-tracking investments in strategic manufacturing, and bank credit growth is holding above 16%. For investors looking past the next few months, the foreign panic has created a valuation correction in an economy that is increasingly owned by its own citizens. The Indian growth story is proving to be resilient, even in the face of a global capital flight.